In this lecture, we will consider trading psychology. So this is about psychology and the emotions. So the outline for today's lecture is an introduction to psychology, fear, greed, and revenge. So these are the emotions people experience while they are trading. They experience fear, they experience greed, and revenge. And the last issue we'll touch The last thing we'll touch is managing your emotions. So many skills are required for trading, and we all know the skills that are required. So you need to understand technical analysis. That's where technical analysis is where we look at charts. So you look at charts, you look at chart patterns, you look at indicators. Technical analysis is important because it helps you analyze the market and helps you determine what direction the price of the asset may go. Fundamental analysis is also important. This is where we look at the economics, the political factors, the social factors. We look at the international relations and how these factors may impact the price of our asset. We look at the factors that might affect demand. We look at the factors that might affect supply and how these factors might affect the price of an asset. So apart from technical analysis and fundamental analysis, an important thing to consider is emotions. Your emotions also affect how you make decisions regarding trading. There are two main emotions that come into play when we are trading. They are fear and greed. Fear. What is fear? Fear is the emotion that arises when a trader is afraid that they will make a loss. I mean, everyone goes in the market with the intention of winning. Everyone wants to make money. No one wants to make a loss. However, the fear of making a loss can affect traders' decisions. Because traders may fear they may make a loss, they might want to close profits too early because they might enter a trade, the trade goes into a profit. However, they do not want the profit to turn around and go in a loss. So they close profits too early and they don't ride the momentum all the way up. The fear of making a loss can also influence traders and can make traders hesitate from taking trades, which could be winning trades. In other words, they can see a setup, the setup might look good. However, because they're uncertain about the market and because they fear of making a loss, they might hesitate and they might not take a trade, which could be a winning trade. So fear is a big problem because with fear prevents you from making the profits and making the gains that you actually could make. Fear is like a limiting factor. It holds you back. So the opposite of fear is greed. Greed is the emotion that arises when a trader wants to make more money from off the market. Greed. What is greed? Greed is when you want to just make more and more money. So greed makes traders take too large position sizes in the sense that when you take a trade, you can go long or you can go short. However, you need to set your lot size. Your lot size is your position size. Your position size is how much you're risking per trade. With greed, traders may take too much of a large position size. So in other words, they might risk too much per trade. The more you risk per trade, if the trade goes in a favorable direction, you can take a larger or a bigger win. However, if you take larger risks, obviously, if the trade moves against you, this could result in a larger loss. Greed can also make traders run down every fluctuation in the market, in the sense that, yes, we can engage in a practice called scalping, where we try to make profits over changes, small changes in the price of the asset. However, greed can make the trader run down every single change in price of the asset. And when they do that, they could use up all of their trading capital. This will be almost equivalent to taking too much of a large position size, in the sense that you can take one trade and one trade can have a large position size. However, you can take a series of small trades and each of the trades can add up to a large position size. So this will have the same effect as taking one trade that is too large. So you can take one trade that is too large and you'll be risking too much of your account, or you can take a series of small trades and cumulatively they are too large, they use up too much of your trading equity, and essentially you'll be taking too much risk. So let us look at fear. In the trading of stocks, when traders get bad news about a certain stock or about the economy in general, they will naturally become scared. They may overreact and feel compelled to liquidate their holdings. In other words, if they had bought certain stocks and they had, I just get use an example, let's say they had 100 shares of a certain stock and they received bad news regarding a company. Fundamentally, the company may be very good and the company could still be profitable. However, because they receive bad news about the company, they can overreact and they can sell off their shares. And this actually does happen, because news are released from time to time, and the news release, it may be relevant to a company, and the company may be profitable, and the bad news that comes out temporarily, the stock price of the company may go down. And some traders may see that, they may become fearful. When this arises, they might sell out the shares of their company. However, if they do that, they might sell off the shares of their stock, and their stock might actually be good stock. They might take up a series of bad trades where they sell off the shares of their stock. But if they had hold their stocks, the stock price could rebound a short period of time afterwards. So fear is a problem. Fear can influence a trader and make the trader take bad decisions. Essentially, fear can prevent the traders from taking trades which can be profitable, or it can make them close their trades that are profitable and prevents them from making the kind of profit that they could make. In contrast, there's greed, where a trader can enter a trade or a series of trades and they are profitable. However, because the trader wants to make so much more money, they keep entering more trades, they keep increasing the lot size, and the trade eventually moves against them, or there may be one trade where the market moves against the trader, and in that one trade where the market moves in such a large direction, it wipes out all the profits that the trader previously made, and the trader ends up making a loss. So what do traders need to do? Traders need to be objective. Objective meaning they're trading without emotions. So in life, there's subjectivity and there's objectivity. Subjectivity refers to how you feel about something. In trading, subjectivity is where your emotions, how you think, affects your decision making. You need to be objective in the sense that you're trading based on facts. You're not trading based on what you like or what you don't like. You're trading based on facts. You're trading based on numbers. You're trading based on things that are not affected by emotions. So traders need to trade assets based on a strategy. And we will see in the next lecture where it is we look at strategies. So take, for instance, a trader may trade based on a moving average crossover, or they may trade based on a price crossover, or they may trade based on, like, let's say they may be implementing a reversal strategy where they're looking for the RSI and looking for the RSI to send a signal that the asset is overbought or the asset is oversold. So once these conditions are met, let's say we run with the assumption that the trader wants the asset to be overbought. So for the asset to be overbought, that means the RSI needs to go above the number 70. So therefore, you only go in short. You only going to enter order to go short, which means to sell on the market if the RSI goes above 70. So that can be an objective strategy in the sense that only when the market meets these conditions, you enter a trade to go short. Likewise, a trader could have a trade to go long. You're looking at the RSI. You're waiting for the RSI to go below the number 30. If the RSI goes below the number 30, it suggests that the asset is oversold. So you're only waiting for the asset to reach oversold conditions. And only when this occurs, then you can go long. So you need to be objective. You need to trade on an objective strategy. You're not trading based on emotions. You're not trading based on, well, I wake up in the morning and I feel the price will go up, but you did no analysis to determine if the price will actually go up. Or you go down the road, you have a friend who also participates in trading, you hear your friend say that he going to short on the asset, but you going long on the asset. So what you do is that you change your position, you close your trade where you're going short, and because you see a friend going long, you decide to go long too. But you have no analysis to actually support that decision making. That is where you're trading based on subjectivity, you're trading based on emotions. You need to do your analysis, and your analysis needs to tell you or inform you about the direction of the market. Do not trade based on opinion. Do not trade based on some subjective factor. Trade based on facts. Trade based on the technicals. Trade based on the fundamentals. Do your analysis of demand and supply. Let this analysis tell you where the price will move. So if you have supply and demand increase relative to supply, what will happen? Well, let's show a demand and supply curve. This is a demand curve. This is supply curve. If demand increase, what is going to happen to price? If demand increase, this demand curve moves from here to here. If demand increase, price will move, equilibrium price will move from this point here to this point here. This will be new equilibrium price. So this is the demand and supply curve analysis. If it is, we have a demand curve here, the demand curve can be D1. Then we can have an increase in demand. So you have an increase in demand curve shifts from D1 to D2. This is the new demand curve. If demand curves increase from D1 to D2, and this was the original supply curve, what happens? Price, equilibrium price moves from P1 to P2. So if you see some kind of factor, and the factor cause an increase in demand, this will cause an increase in price. Let me give you an example. Assume that we're looking at, let's say, we're looking at corn, and for some reason or the other, corn increases, there's an increase in demand for corn. So corn increases in demand relative to supply. What happens? Well, we'll have an increase in the price of corn. This is how the market will react. Likewise, let's say we're looking at supply. Let's say this was the original supply here, S1. This was the original equilibrium price, P1. This was equilibrium quantity here. This was equilibrium quantity down here. So if you have an increase in supply, if supply moves from S1 to S2, then price will change from P1, it will go to P3, and the new quantity will be Q3. We might be concerned about the quantity, we're just interested in price, how the price will move. This is where we do demand and supply analysis. Let's say we look at an example. Let's say we have a decrease in supply. Let's say the supply was S2, this was the original supply, S2, and the original demand was D1, and this was the original price, P3, and the original quantity was Q3. Assume something happened that negatively affects supply. So the entire supply curve shift backwards. supply will shift from S2 to S1. If supply shifts from S2 to S1, what will happen with price? Well, we can see here, price will move from P3 to P1. There's a backward shifting supply curve. It will intersect the demand curve at a higher point. Price will increase. Let me give you an example. So in the year, I believe it was 2020, I can't remember if it was 2020 or 2019, but I really believe it was 2020. There was an attack on an oil refinery in Saudi Arabia. And when there was some attack on the refinery, now Saudi Arabia is a big country, and this country is a major producer and exporter of crude oil on international markets. So they could actually influence the price of oil. Yes, they are part of an organization called OPEC. They are the leading or one of the leading members of OPEC. However, when there was this negative news that was released regarding their oil refinery and how their oil refinery was attacked, this sent a signal that there will be a decrease in supply of oil from at least from Saudi Arabia. When this occurred, traders started to react. Traders started to speculate. If there was a decrease in supply moved from S1 to S2. If demand remained unchanged, what will happen? It will cause an increase in price from P3 to P1. Using that basic demand and supply analysis, traders realized that the price of the asset will go up. So you know what traders did? Traders started to buy the oil. The oil was a commodity, and crude oil went up immediately. Crude oil went up, and that the news of the oil refinery attack caused crude oil to go by $6. It went up in one shot. This is what we do when we do fundamental analysis. We look at the demand, we look at the supply, and we look at what will happen to demand, what will happen to the supply. And based on these demand and supply factors, we can determine that if the price will go up or if the price will go down. And this can inform our decision making regarding buying or selling the asset. When we do this demand and supply type analysis, we are trading objectively. We are not trading based on emotions. We are trading based on the fundamentals and what the fundamentals are telling us. This is how we need to trade. So you can trade based on technical analysis, where you look at your charts, your chart patterns, your indicators, and this can tell you if to buy or to sell. Or you can trade, or you can use, additionally, you can use fundamental analysis, where you look at the fundamentals of the market, and this can tell you if to buy or sell an asset. This is how you're supposed to trade. You don't trade based on emotions. You don't trade because you just feel a VAPS and you just feel to sell the asset. You just feel to buy the asset, but you have no technical analysis. You have no fundamentals. You have nothing objective informing you about the decision, and you just randomly buy or sell the asset with no analysis. That is madness. That is a recipe for disaster. If you're trading based on emotions, on how you feel, I mean, I don't want to criticize your emotions, but that is not the best way to trade. And it's a very strong possibility that if you trade based on emotions, trading might not work for you. In other words, you might not be profitable. That is just a reality. If you're trading based on emotions, trading may not work for you. You might end up taking some trades, and the trades might end up being losses. And you might want to hold your losses for too long. So you might end up taking a loss, and you don't want a loss, and the loss just keep growing and growing and growing because you're emotional, and you say, I don't want to close the trade because it's going to a loss, and the loss go from a small loss to a very big loss because it was not trading based on a strategy. You're trading based on emotions. Likewise, you might take a trade and you're going to profit, but because you fear that the trade could turn around and go in a loss, you close the trade one time. So enter a trade, the trade going a profit, you're in about $200-300 in open profit, rather than hold that trade and let it ride and make about $1,000, $2,000, $3,000 in profit. You close the trade with only about $100 in profit, and you end up taking too much of a small profit. So, and this will affect your risk to loss ratio, you know, because you want when you take a win, the win ends up being a big win. You want when you take a loss, your loss ends up being a very small loss. However, if you trade based on emotions, you end up taking losses that are too large. You hold the losses for too long, and these losses end up becoming too large. Likewise, if you trade based on emotions, you can take wins, yes, but you close your wins too early and your wins end being too small. So you end up with a win to loss ratio that is not very good. Ideally, you want a win to loss ratio of 3 to 2. And if that is the case, so then if you win, every time you win $6, you only lose $4. Every time you win $60, you only lose $40. If it is a trading based on that win to loss ratio, 3 to 2, this will be profitable for you in long run. Think about it. So if you win $6,000, you only lost $4,000. So it'll be net profit by $2,000. If you operate with that win to loss ratio, you will be profitable over time. You will be profitable in the long run. So the next thing we want to touch is revenge trading. So you might wonder, what is revenge trading? Now, sometimes a trader takes a trade and the trade ends up being in a loss. So this can happen, and this happens all the time. You might take a trade and trade ends up being a loss. However, because the trader doesn't want to make a loss, they want revenge on the market. So they want now, when they go back and take a next trade, they will take a larger position size. So they buy the asset was, rather than the asset go up, the asset went down. And because the asset went down, they end up now taking a loss. And when they want to enter a new trade now, they want to buy again, yes, they want to go long on the market. However, rather than using the same lot size, they take a larger lot size. So they end up taking, so they come like they're implementing a revenge trade. You want to now immediately make back all the money that you lost and taking larger lot sizes, or alternatively is try to take more and more trades. So you take one trade, the trade has been a loss, and you know you got one, make back that money that you lost. So you take 2, 3, 4, 5 different trades afterwards, and you're so eager, you're so enthusiastic about trying to make back the same money that you lost. So you're trying to take revenge on the market. This is a recipe for disaster. You need to be objective. You do not trade based on emotions. Do not trade based on revenge. It is madness trying to take revenge on the market. Trade objectively, trade systematically. You need to have a strategy. Your strategy needs to tell you when to enter a trade, when to buy. Your strategy needs to tell you when to enter a trade and when to sell, what should be a target profit, what should be a stop loss, where should be the entry position. So if you're going long, at what candlestick, at what point should you enter the trade to go long? What should what your entry price should be? What should your stop loss be? What should your target profit be? Your trading strategy should inform you about all these different things. Traders need to trade based on well-defined trading rules. How do you learn to manage emotions? So this is a very good question, because some people are emotional. A lot of people are emotions. A lot of people have emotions. Some information, like the information. We might hear some information, don't like the information. Sometimes you go and sleep, you wake up in the morning and you might feel very good. And sometimes because of how the day progress and the things that you encounter in the day, your emotions might change and you might feel upset or so forth. No problem. However, when you go on the market to trade, do not trade based on emotions. Detach yourself based on emotions. So how do you learn to trade without emotions? Well, the first thing to do is to start by demo trading. Demo trading is where you trade with fake money. You trade with paper money. It is also called paper trading. You're not trading with a live account. You're not trading with your real money. You're trading with fake money. When you are engaged in demo trading, essentially what you're doing is that you're trying to feel out the market. You're trying to practice when you're trading with money and the money is not real money, but you want to see when these conditions occur, if you'll go long, if you'll go short, how fast can you go long? In the sense that you might see a setup and you want to go long on the market. However, sometimes because you're new to trading, you want to enter a trade, you might want to do it on your phone and you're making mistakes. You want to go long, but instead of going long, you go short. You want to go long, but you forget to adjust your position size, your lot size, and you enter a trade and the position size is too large. Or you want to demo trade and you want to practice. So you might enter a trade, yes, and you're having problems setting market orders, or you're having problems setting change from market orders to limit orders. You can also practice, we can practice setting your target profits and setting your stop loss. So you have to practice these things. You have to try and get accustomed to these things, because if it is now you go on the market with your real money, you don't want to go on the market and you're still figuring out how to change your lot size. It's still figuring out how to set a stop loss. You're still figuring out how to set a target profit. You still have problems with fear. You still have problems with greed, and you want to make money. You want, when you go on the market, you're comfortable, you're composed, and you know what to do. So as a rule of thumb, I recommend that before you go on the market with real money, that you practice demo trading. Practice demo trading for about, let's say, about 3 months or 6 months. You want to start with a small account, about $500, and you want to double account. You have to prove to yourself that, hey, I can grow my account and I can double my account. I can grow my account from $500 to $1,000. If you cannot grow a demo account from $500 to $1,000, you think you could do that with a real account? If you can double or triple or increase your account, a demo account, by 4 times, now a demo account is easier to trade in the sense that you know for yourself that this is not real money. If it is now, the trade's not as profitable as you want, it's another problem because it's not real money. You think if it can't manage a demo account, you think you can manage a live account? Most likely you wouldn't be able to do it. You have to practice with fake money first. You have to practice with a demo account, and you have to prove to yourself that you have a strategy that works. Some people go on the market with their real money and trading doesn't work for them. These people might be implementing a strategy and they think that the strategy is supposed to work. These people might implement a strategy that they think is supposed to work. However, for some reason or the other, the strategy does not work. What these people need to do while they are demo trading is practice a strategy or practice multiple strategies. And then they need to teach themselves, and then they need to prove to themselves that they have a strategy that is working. In the sense that while you are demo trading, you need to implement a strategy, and you trading based on some systematic procedure. So only when you prove to yourself that this systematic procedure, this objective strategy, these rules that you implement over a period of time, over and over and over, you need to prove to yourself that this strategy works for you. If you cannot prove that a strategy works for you, do not go and trade with your real money. That is just a rule of thumb. You will almost, this is a recipe to almost lose your money when you go live. So in summary, this is what you need to do. You need to learn to manage your emotions. You need to practice demo trading. You can start with a small demo account, then grow it. I recommend this because a lot of people will not start trading with a large account. They will start with a small account. So practice first with a small account in demo trading, and practice growing that small account and doubling it and tripling it and growing it to 4 times the initial value. When you start and when you go live, start by taking the smallest possible lot sizes. And I strongly recommend this because if you implement a trade and the trade goes against you, this will not wipe out your account. This will not wipe out a large proportion of your account. This will only take a small size of your account, and it allows you to feel out the market, and it allows you to get confidence. It allows you to get experience, grow, and develop. And when you get comfortable in taking trades and implementing these trades and becoming profitable systematically over a period of time, you can gradually increase your lot sizes. This allows you to manage your risk. So this brings us to the end of this lecture. And in the next lecture, we will look at trading strategies. Thank you.